To the class Corporate Accounting. Myself, Dr. A. Devi, Assistant Professor, Department of Commerce, KCS Kazinadar College of Arts and Science. In this video, we will see the basic concepts. Introduction. Corporate accounting is a special branch of accounting which deals with the accounting for companies. Corporate accounting is nothing but company's account. We know what is company. So in there, how they are maintaining the accounts is going to be the subject under corporate accounting. Financial accounting focuses on posting of journal, ledger, trial balance and preparation of final accounts like trading account, P&L account and balance sheet for sole proprietorship and partnership. You might have a doubt that you have already studied financial accounting, then what is it about? The financial accounting paper which you have studied in the first year is for sole proprietorship and partnership, whereas the corporate accounting focuses on company's account of public limited company, specialized companies like electricity, banking, insurance companies, and the accounting treatment in the special occasion like merger, acquisition, liquidation of companies, etc. Accounting treatment for issue of shares, redemption of shares, underwriting of shares, alteration of share capital, etc. are to be studied in this paper, and this is going to be your odd semester syllabus. Company. Define company. The Companies Act 2013 of India defines a company as a registered association which is an artificial legal person having an independent legal entity with a perpetual succession, a common seal for its signature, a common capital comprised of transferable shares and carrying limited liability. The example for company is ITC Limited, which is well known for various fast moving consumer goods like what you have seen in this picture. Okay, and this definition is actually depicting the characteristics of company. See the first one, it is a registered association. Of course, the company must be registered under Companies Act, then only it can commence its business. And it is treated as an artificial legal person, as like our natural person. Company is an artificial person that can purchase an asset, that can borrow a loan, and this company can enter into an agreement, and these can do the sale transactions, and this can sign in any kind of tenders, and artificial legal person is going to submit its IT return to. As the company is doing all these things, it is treated as a legal person having an independent legal entity. The owner is different and the company is different. And with a perpetual association, which means that men may come and men may go, but the company will be ever. Though the existing members have been gone, the company will continue with the new members. It can continue. It need not to be dissolved as like a partnership firm. A common seal for its signature, as the company is enter into an agreement and it is purchasing its assets and borrowing loan, it must signed. So for its signature, the common seal is being used. A common capital comprised of transferable shares. The company should have shares in the form of capital, and which is to be applicable for transferable, and carrying limited liability, and owners are limited with their liabilities if in case of liquidation or in winding up, their liability is limited with the amount they have invested into the business. Shares and its types. What is share? The capital of a company is divided into small units which are commonly known as shares. So the company is inviting the general public to invest their money into the business in the form of share. Then what is share? The capital of a company is divided into small units which are commonly known as shares. So the company, if suppose the company wants an additional capital of rupees 1 lakh, the company can issue a shares for at the rate of rupees 10 per share. Then the company will issue 10,000 equity shares at the rate of rupees 10 each, and this will become their additional capital. Share is of two types, equity share and preference share, and there is a difference in the rights between the preferential shares and equity shares. Preferential shareholders are having preferential right to claim their dividend, which means once the company settled all its payments in the year end, the dividend will be given first to the preference shareholders, then only the equity shareholder will get dividend. This is the major difference between the preference shares and the equity shares. And moreover, the preference shareholders will get a fixed rate of dividend, whereas there is no fixed rate of confirmed dividend for equity shares. So once the fixed rate of dividend is given to the preference shares, whatever be the surplus profit available in the hands of the company will go to the equity shares. So the equity shareholders are the real owners because they are bearing the risk. Equity versus preference shares. So in what way these two shares are varying? One, preference share is paid, the dividend is paid on preference share before it is paid to the equity shares. I hope you could understand. Equity shareholders dividend will be paid only after the dividend payment of preference shares, and rate of dividend is fixed for preference shareholders, whereas there is no fixed rate of equity. The amount which is to be given as an dividend will be decided in every year board meeting. And preference shares are redeemed on due date, which means the preference shares will be taken back by the company and the amount will be settled to the preference shareholders, whereas there is no redemption concept in equity shares. The company may buy back its shares, but there is no redemption concept. Preference shares have voting rights only in special circumstances, whereas equity shareholders have voting rights in all circumstances. A new company cannot be formed only with a preference share, whereas the new company can be formed with the equity shares. There are 8 types of preference share, but there is no such type of equity shares. Only the sweat to equity shares are covered under this category. Let me see the 8 different types of preference shares. Types of preference shares: cumulative and non-cumulative, which means what we discussed earlier, the fixed rate of dividend will be given to the preference shareholders. If the company is not having adequate profit to give that fixed rate of dividend during such particular year, then this can be treated as an arrear and can be settled along with the next year dividend. Whereas if it is a non-cumulative preference share, there is no such provision. Convertible and non-convertible, which means the preference shares is having a right to convert its preference shares into equity shares, whereas there is no option for non-convertible preference shares. Redeemable and irredeemable, the preference shares, while they are issuing, at the time of issuing itself, they'll get into an agreement that the same will be redeemed after certain period, which means taken back by the company after certain period. Whereas if it is an irredeemable preference shares, there is no such option. Then participating preference shares and non-participating preference shares. If it is a participating preference shares, if the company is having a surplus profit, then this kind of preference shareholders will get an additional dividend. Redemption of shares. Redemption of preference shares, which means repayment of preference share capital to preference shareholders. This also we already discussed. The company will repay the share capital amount and they will not continue as a shareholders after the redemption. But there is a revision in the redemption case in Companies Act 2013. No company limited by shares shall, after the commencement of this act, issue any preference share which are redeemable. So which means the redemption of preference share is compulsory. The company cannot issue an irredeemable preference share. Stock split. This is a concept in which a public company divides its existing shares into multiple shares to boost the liquidity of the shares. Which means, for example, the 100 rupee share is being splitted into 250 rupee shares, so that the number of shares will get increased, so that the investors can, the more number of investors can enter into a business. Debenture. This is also another concept the company is issuing to raise its capital, to raise its fund. Debenture may be defined as an acknowledgement of a debt by the company. It is not like a share. because shareholders are the owners of the company. They are investing their money to become the owner, and they will take share out of the profit earned by the company. Whereas debenture is a debt certificate. If the debenture holder is giving in money which is being given for the interest amount, which is being given as a loan, it is not given as a capital. So these people is not having a right to share the profits earned by the company, whereas they will get only the fixed rate of interest. Debentures are creditorship securities which provides funds to the company on loan basis rather than capital basis. Debenture holders are entitled to periodical payment of interest at a fixed rate. Types of debenture: secured debenture, unsecured debenture, which means the debenture is being issued on fixed charge of certain fixed assets. So which means the debenture holders are taking some rights on fixed assets and they are giving money. So if in case of issuer is failed to pay their payment, either a principal amount or an interest amount, then this debenture holder is having a right to sell the property and take the settlement. Whereas if it is an unsecured debenture, there is no rights to them. So they have to get money only if the company is having sufficient balance with them. Redeemable and irredeemable concept, the same thing what we have seen in the preference shares. So this kind of debentures will be redeemed after certain period, which means the amount will be settled after a set period, like it may be of 3 years, 5 years or 10 years. Whereas if it is an irredeemable, there is the company will not taken back on a certain limited certain period. Then convertible debenture and non-convertible debenture, the debentures can be converted into a equity share after certain period, provided it is to be of convertible debenture. And if it is non-convertible debenture, there is no such option. So they have to settle their debenture and they have to take back the money. Registered debentures and bearer debenture. In this, if it is a registered debenture, the full details of the debenture holder will be registered in the documents of a company. So they are losing the facility of negotiating, transferring the debenture certificate to others. So only they have to return back their debenture certificates to the company. They cannot transfer or sell the debentures to the others. If it is a bearer debenture, it will be treated as a negotiable instrument. So the debenture holder can transfer it to the others on his own wish. Redemption of debentures. Redemption of debentures means repayment of the amount of debentures to the debenture holder, or discharge of the liability on account of debenture, which means the company is no more liable to pay any amount to the debenture holders. They are discharging their liability while they are redeeming the debentures. A company is authorized by its article of association and the terms of issue and redeem the debenture before the due date in prospectus. So which is given as per the article of association rule, which is being given in the prospectus, the company will do its redemption. Thank you for watching this video.